The Deficit Commission put out a pretty good plan. It was deadpanned by this administration. Had they come alongside, started supporting that a long time ago, we wouldn't be where we are today.
That's Republican Senator Tom Coburn on NBC's Meet the Press yesterday. Coburn, of course, is a member of the bipartisan Gang of Six who went public last week with their own plan to cut the U.S. deficit and raise the debt ceiling that received support from President Obama. Let's bring in Peter Morisi, economics professor at the University of Maryland, David Drucker, staff writer at Roll Call, and CNBC's John Carney is on set with me. Peter, good to see you this morning. Based on what we're seeing in terms of futures and not a lot of market panic selling, do you think the market is actually recognizing that what's going on in Washington is non-threatening political theater and that the Treasury can actually continue to make interest payments on time?
Well, the Treasury certainly can continue to make interest payments on time, and Secretary Geithner is doing us all a disservice by trying to scare markets in an effort to give the administration political leverage. The Treasury will collect about $180 billion a month in revenue each month, and the debt service is only $30 million at best, even if we include the payments to the Social Security Trust Fund. So we're certainly not going to default on our debt.
So what does the day after look like, and do you think the Treasury would take a page out of, say, Minnesota's playbook, prioritizing expenditures, rolling over bonds if they're coming due, taking care of the important stuff like Social Security first? Would that be enough?
Well, they have the capacity to do so. The question is, are they making preparations? Because the Treasury makes millions of payments every month through banks distributed around the country. So they have to prepare for this day to properly execute. It's a much bigger problem than Minnesota, but he certainly has the capacity to do that. Beyond prioritizing payments and meeting about 50 or 55% of federal obligations that way, which would include Social Security, the Treasury does have other options. For example, it can theoretically print currency. Not theoretically, it can. And the Federal Reserve can sell the bonds that it owns, that it acquired through QE2, to absorb the excess liquidity and basically run QE2 in reverse to finance other aspects of government if they choose to. That's perfectly legal, and since what the Fed holds already counts towards the debt ceiling, it doesn't pierce that limit. So they have lots of options, and by not admitting to them, they're arbitrarily setting a deadline that really doesn't exist.
Peter, can I ask you just a question about that, because I think that's really interesting. What you're saying is that the Fed could sell the bonds that they hold and then give that money back to the Treasury and fund the U.S. government operations like that.
Well, essentially what happened during QE2 was the Treasury printed bonds and sold them, and the Fed bought up about 85% of them. They were monetizing the debt. Now, the Treasury could print currency, theoretically. It would actually be electronic money to pay expenses. That would create too much liquidity in the system. But the Fed could turn around and buy bonds, buy that currency back with the bonds that it holds to keep the money supply approximately where it wants. And that process could go on for a very long time, because not only does the Fed hold about a year's worth of debt, or a year's worth of deficit spending in bonds, but also the money supply does expand, so there's a lot of latitude, and it has other securities, like agency bonds, Fannie Mae's and Freddie Mac's and so forth.
Peter, hi, it's Louisa in London. I enjoy your writing, so thank you very much for that, first of all. Second of all, does that mean then that investors are going to be positioning themselves in cash if that were to happen, or would they put that money to work in equity markets?
I would think they would do both. Once they realize the world is not coming to an end, and of course this is up to Mr. Geithner to decide whether the world comes to an end or not. He could say we're not making payments, and bring about a crisis. But if the Treasury acts responsibly, then people will recognize that even the S&P downgrading the United States might not mean a lot, because what else do they do with their money? You're going to put it in Euro bonds with the way things are over there? There aren't enough Canadian and UK bonds, which are also AAA, around. Recently the S&P downgraded, and it was hilarious. They downgraded Japan. The Japanese truly owe the money to themselves. They save too much, so the government spends it on their behalf. To say Japan has a potential default problem greater than, say, the UK or Germany is absolutely absurd. But the trouble is, they evaluate the United States and other big countries the way they would evaluate Togo. It's absolutely absurd.
Okay, so it's certainly political theater, David, but do you think the Fed and the Treasury are encouraging markets to panic by also coming out and being pretty reticent, pretty stern about their options moving forward? What have you been hearing?
Well, I think part of the issue here in Washington is not everybody believes that a crisis would ensue if the U.S. defaults, if we don't do something by August 2nd. And I've said sort of half jokingly over the past couple of weeks, if you really want to motivate people to strike a deal, to compromise, it would be good for the markets to tank for a few days and turn this crisis from hypothetical to real. And so as long as the markets kind of hum along, assuming that this problem is going to be taken care of or not being concerned for other reasons, for the people resisting whatever compromise is going to be necessary, they look at this and they say, what's the big deal?
David, the Obama administration insists that there is no plan B. Is that true? Are they really not making any preparations if they can't get a deal?
Well, no. The Treasury Department has been making preparations and trying to figure out what they're going to do if there is no deal. And clearly, at this point, the president, in my view, will sign whatever gets to his desk. So any plan that can get through the House and through the Senate and land on his desk, at this point he'll sign, whether it's short-term, long-term, doesn't have tax increases, isn't balanced the way the president wants. So any plan B, C, or D that gets to him, he'll sign. And as Treasury Secretary Geithner said over the weekend, they have taken a look at what they can pay and what they can't, and they may not be as forthcoming with the options they'll choose, but clearly they've taken a look at this.
All right, gentlemen, we're going to have to leave it there. Thank you so much, Peter and David, for checking in with us from Washington. John Six around as well. And coming up next, still no deal for U.S. lawmakers.